The latest reading on GDP showed the economy shrunk by 0.7% during the first quarter. That's slightly better than the 0.8% decline economists expected. And for analysis, let's get straight to Michael Hanson, a senior U.S. economist at Bank of America Merrill Lynch. And Michael, this is the second estimate on GDP. The first one showed that the economy actually grew by 0.2%. So what happened here? Should we just chalk this up to cold weather again?
Weather probably played some role, but if you look at where the big swing was between the initial release and today's numbers, there are basically two things. One was the trade deficit was a fair bit wider, in fact the widest it's been in several decades, and that obviously reflects the strong dollar, maybe a little bit of the port shutdown on the West Coast. And then you saw inventory build that was not quite as strong. Instead of adding 3/4 to GDP growth, it only added 1/3%. So you put those two factors together and you got a weaker number. Not quite as weak as perhaps people were looking for. So we take maybe a little solace in that. But yeah, I mean, the first quarter was not a good quarter. And there were definitely some factors like weather and the port shutdown that will be reversed when we get the Q2 numbers out. But then the impact of the dollar is going to be with us a little longer.
Yeah, all right. Now, GDP is a lagging indicator. Of course, we have the Fed betting that the slowdown during the first quarter is temporary. But what do you think? I mean, have we recovered from the softness seen towards the beginning of this year?
The data is still mixed. It's definitely better than the steady stream of bad data we had earlier in the year. But it's not really compelling just yet. And so I think the Fed is still trying to play for time. You know, you hear Fed officials basically saying they're data dependent and every meeting is still live. The threshold for the Fed hiking may not be all that high. I think if inflation moves sideways and not down, that's probably good enough. I think if the labor market continues to improve, which it has, and we'll get obviously a number next week, that'll help. And some indication that we get a bit of a bounce back in Q2 could allow September to still be on the table. I don't think June is very likely at this point.
All right, so if we haven't recovered one way or another, I mean, where does that put the Fed in terms of prepping the markets for a rate hike whenever they pull the trigger?
Yeah, I mean, they've tried to de-emphasize the idea that the rate hike itself is a big deal. They're talking a lot about this is the beginning of a very gradual normalization process. The Fed's view is that the unemployment rate's down in the low 5s. It could get even below 5 by the end of the year. While inflation in this report didn't show any signs of picking up, Fed officials still seem quite comfortable, perhaps a little bit too comfortable with the idea that inflation will get back to target in the next year or two. So in their view, that's not a world that justifies zero interest rates anymore. So it's obviously not an aggressive hiking cycle they have in mind, but they want to start getting back gradually towards something that looks more like normal because they think the economy is getting there. The data hasn't cooperated as much as they were hoping.
Yeah, all right, we'll certainly be watching that. All right, Michael Hanson, senior economist at Bank of America Merrill Lynch, thanks for your time. I'm Scott Gamm, and you're watching The Street.